The Reserve Bank of India announced its monetary policy review today, coming a few weeks before the Union Budget. Governor Rajan chose to maintain a status quo. He left repo rates unchanged at 6.75%, but indicated that borrowers can expect cheaper loans by April 2016. Now, the day the credit policy is announced should be a good enough day to review banking terminology. So if you're planning to finance your home through a home loan, stay with us as Juika Desai decodes the base rate and spreads for you.
Base rate, spread, prime lending rate. Enough terms there to confuse the average home buyer. Time now to be unconfused. So how do you know whether you have got a good deal on your home loan? It's pretty simple. Let's start with the basics. Interest rates. Simply put, interest rates is the cost that you pay to the bank for borrowing money from it. This is charged as a percentage of the loan amount and is payable every month. Hence the term EMI or equated monthly installments. Base rate, margin, spreads are all part of the formula used to arrive at this interest rate, which in turn determines your EMI. Let's tackle base rate first. You will encounter this term if you were to take your home loan from a bank. It is the benchmark rate below which the bank will not lend to anybody. Banks calculate interest on this base rate, which is theoretically linked to the repo rate of the Reserve Bank of India. This is the rate at which the bank borrows money from the RBI. So if the repo rate is hiked, your base rate should go up, and so will the interest on your loan. Conversely, if repo rates reduce, which is what is happening today, your base rate should also go down and your home loan should get cheaper. To arrive at the final lending rate, banks add some percentage points to the base rate, which is called the spread. The spread is how banks earn money on loans they give you. Quick tip here. Opt for a bank that has a lower spread, because when spread is reduced, it only benefits new borrowers. Existing customers still have to pay EMIs at the same rate of interest. Now, what banks call spreads, home finance companies call margins. The only difference being that they subtract the margin from their prime lending rate or PLR to arrive at the rate at which they lend to you. So if you're taking a home loan from a housing finance company, ensure that you opt for one that charges a higher margin.